Tax loss harvesting. Ever heard of it? Okay, not many people have. What it does is it saves you money on your taxes without even lifting a finger. You don't believe me? That's fine. Watch this video and you'll find out. Hey, my name's Tony. I work at Wealthfront. I love talking everything money. So today we're going to talk a little bit about tax loss harvesting and how that really works. First off, tax loss harvesting can be a really good thing. It leaves more money in your pocket. Not less, more money in your pocket left over to invest or save for other big financial goals you have. Why wouldn't you want that? So here's how it works. When an investment is sitting at what's called a loss, basically less of a value than what you paid for it, which is very common, tax loss harvesting or automated tax loss harvesting might step in and actually sell that security, take those cash proceeds that you get from selling the security, and then reinvest them in a similar, not identical, but substantially similar security as you had before. All in all, the characteristics of the portfolio aren't really changed. You just get to use those losses to offset potential capital gains. So let's look at an example. You have an investment worth $10,000. A month later, it drops 10% to $9,000. Automated tax loss harvesting might step in and sell those investments for $9,000 and create what's called a $1,000 capital loss, also known as $1,000 in harvested losses. But how does this actually save you money on your taxes? Well, the IRS lets you use these harvested losses to offset a few different things. Number one, long-term capital gains. Number two, you can use them to offset short-term capital gains. Number three, you can use them to offset up to $3,000 of ordinary income. Number four, if none of those apply to you, you can simply carry forward the losses to future years when it's beneficial and you can actually use them. All right, number one, capital gains. Probably the most common way that you're gonna use tax loss harvesting to benefit you. So you sold an investment, all right? That creates a capital gain if it's sold at a gain, basically more than what you paid for it. Very simple, right? Well, there's two different types of actual capital gains, short-term or long-term. Short-term capital gains is basically where you sold the investment less than 365 days from when you bought it. Long-term capital gains means you sold the investment anytime after that, basically longer than a year. Short-term capital gains are taxed at a much higher rate, your ordinary income rate, whereas long-term capital gains are taxed at a typically 15 or 20%, depending on your income. Number two, you can use the losses to offset up to $3,000 in ordinary income every year. Okay, you get your paycheck every other week, let's say. Haven't you ever thought, how can I prevent the IRS from taxing me more on this? Can I just maybe withhold them back and maybe avoid some of these taxes? Yes, you can. Tax loss harvesting allows you to do that. Now, what if you don't have any capital gains or much income to actually offset with those losses? That's fine. The IRS allows you to carry forward those harvested losses to future years. You simply carry them forward to the next year, and if the same situation arises, you continue to carry them forward. You're good to go. Okay, so now that you know how these harvested losses can be used, let's go through an example. You have two investments. One of them, you've generated $4,000 in harvested losses for the year. The other one, you've generated $500 in capital gains. You can use the $4,000 in losses to completely offset the $500 in capital gains, meaning that you've saved potentially up to $75. That's pretty good. Okay, so you still have $3,500 in losses left over. Now, the IRS, of course, allows you to use up to $3,000 in ordinary income to be offset with tax loss harvesting. After that, you'd still have $500 in losses left over. The good news is the IRS does allow you to carry those forward to the following year, so you'll still get to use them at some point. All right, so you might be thinking that example is pretty complex. Here's something to think about. 96% of our clients have received enough savings from tax loss harvesting to completely offset the fees that they've paid. Even better, what we've found is that clients receive a benefit up to 13 times the fees that they've paid. Basically what that means is that when you sign up for Wealthfront, the fees that you've paid are typically offset by tax loss harvesting benefit just alone. Thanks again for coming to watch. This is Tony from Wealthfront. We'll see you next time.